what we've been talking about up to this point in this chapter was deductions that were available to us before we reached AGI. So these were deductions from our income, and then we would calculate from that what our adjusted gross income was or is. We're now going to move to what are known as below the line deductions. So we've made that calculation of what our AGI is. Now we're also entitled to some additional deductions in order to get to taxable income. And the first of which we will talk about is a deduction for medical expenses. Now, again, these are itemized deductions. If an individual taxpayer or married taxpayer, I guess I shouldn't have said individual, but if a taxpayer is going to avail themselves of the standard deduction, none of what I'm about to talk about here applies, because they will just take their standard deduction for an individual or for a joint filing, and they will not be able to deduct any of these things except, or unless I should say, the total, if you were to add all of these things up, is more than their standard deduction. Then this is something that would pertain to them. So the first thing that we're going to talk about is medical expenses. And again, this is only a deduction that somebody would be considering if the sum total of their itemized deductions was going to be more than the standard deduction that was available to them. And this is also the reason why it is now such a benefit for self-employed folks to be able to deduct their self-employed health insurance premiums as a for AGI deduction, because prior to that, prior to being able to do that, their only option was to deduct it as a medical expense, which we're about to talk about. And you will see that in order to deduct medical expenses, the amount, the dollar amount, has to be really quite substantial. And in fact, so substantial that unless you've had some sort of a catastrophic health crisis or chronic condition, you're probably not going to have much that can be deducted here, if anything at all. So let's take a look at what this is. And again, it's the first thing that you will see on Schedule A, which is the form that is completed for itemized deductions, and then that number gets transferred at the end result of that form gets transferred to the 1040. So these are only unreimbursed medical expenses. So if insurance has paid it, it doesn't count. And lest you question that, here is the deduction that sets forth that analysis. So you are going to take gather up all of your receipts for your prescriptions, your glasses, your contacts, your copays from when you go to the doctor, all of those things, and add them up, and then subtract whatever your insurance paid. Then you determine 10% of your adjusted gross income. So calculate your adjusted gross income, which you have already done by the time you've even reached this analysis. Take 10% of that number and subtract it from the total of your unreimbursed health insurance expense. And if there's anything left over, you get to deduct that. So think about this practically. If your adjusted gross income is $50,000 a year, you have to have more than 10% of that, so more than $5,000, in order to then have anything to deduct. Now, it's not as though if you exceed that 10%, you can deduct the whole thing. No, if you have $5,001 in unreimbursed medical expenses, you can deduct $1. Yay. So this is why it was often very difficult for self-employed folks to even be able to take that deduction, because to get there, and it hasn't always been 10%, but nonetheless, in order to get there, it was a bit of a challenge. What qualifies? I had listed off a number of them, and I won't go through them all here on this slide, but I think the thing I didn't talk about is transportation for and lodging for medical expenses. If you have to travel to your appointments and that requires an overnight stay, if in this area you got to go to Boston, for example, you can deduct that. The mileage rate that you can deduct is not the standard mileage reimbursement rate for business travel. It is much less than that, and it is 20 cents a mile. You can deduct the actual cost of tolls, fees for parking, things of that nature. Your lodging is limited to $50 per night, but pretty typical stuff that you would expect that you could deduct. And again, it lists here medical insurance and all of that. This would be your this is not something that is already pre-tax. So you can't take your pre-tax deductions or health insurance premium that you paid through your group health insurance plan and then add it again here to try and deduct it twice. Won't work. Not deductible things. So things for general improvement of health. I need a mental health day, so I'm going on a drive. Can't deduct that at 20 cents a mile. Cost of marriage counseling. I just won't go there. Cosmetic surgery, if it's unnecessary, and I think by definition, if it's cosmetic, it is unnecessary. Over-the-counter medication. So if you need Tylenol, doesn't go into the analysis. Drugs illegally purchased from abroad. Now we'll contrast that with prescriptions. Some folks will buy their prescriptions from Canada because it's less expensive. As long as it's not illegally done, you've got a legitimate prescription, you saw a doctor, and it's just being filled in Canada, you can still make that deduction. So let's take an example, and I had just given you one a little bit ago. This is bad. So we got Frida and Jose, and they've got the following medical expenses: contact lenses, facelift for cosmetic purposes, doctor's bills, medical insurance, premiums. What can they owe? And they've also got 260 miles to see a cardiologist in July, for which they use their personal automobile as opposed to a taxi or some sort of public transportation. Their insurance company reimbursed Frida and Jose $1,000. What is their deduction during the year for medical expenses? So we've got we've got basically everything. We've subtracted the insurance, and the calculation is below for the mileage. And now let's not confuse the statement I made a few minutes ago about medical insurance premiums. How would you get a deductible medical insurance premium here as opposed to one that's self-employed or the rest of what's part of a group health plan? And the answer is you're not self-employed and you are not participating in an employer-sponsored health plan, and you are just paying your out-of-pocket health costs. These can be used to try and get you to that above 10% of the AGI threshold so that hopefully you can deduct something. And so we're going to, and I guess maybe I jumped off of that too quickly. So this $2,452 in this example is what is deductible, because after the 10% of AGI that is subtracted from the unreimbursed medical costs, that is all these poor folks have left of the $5,500 they legitimately actually spent, not in counting her facelift. Oh, and I said her. Could have been his facelift. I don't want to be sexist at all. So we're going to move from healthcare costs to taxes. Taxes generally deductible, fees are not. And so in New Hampshire, for example, there is a portion of the motor vehicle registration, which is a tax versus a fee, and the tax portion deductible, fee not. So you can deduct state, local, foreign income tax. You can also, if you are in a jurisdiction where you're paying sales tax, you can deduct sales tax in lieu of state and local. So you've got it's a one or the other. So you've got to add up what you're spending on sales tax versus what you're paying in state and if you have local income tax, and then figure out which is more and which would be a more advantageous deduction. If you are paying personal property tax, if you're in a jurisdiction that charges personal property tax, that is also potentially deductible as well. Now, what happens if you are paying personal property tax on your vacation home in the Bahamas, let's say? Not deductible. You cannot deduct the property tax on foreign property. Although potentially if you were using it for rental, that might be another option. So there are limitations, however, to what can be deducted for taxes. So the total amount is $10,000, $5,000 a piece if married filing separately, and this is for all of the following: state and local real estate taxes, state and local personal taxes. So you've got to add all of this stuff up together. So this deduction for taxes is not unlimited. You are limited to $10,000, $5,000 if you're married and each of you are filing separately. And so all of your taxes, regardless of how much you actually pay, are limited to a $10,000 deduction. And I'll talk a little bit more in a minute about sales tax versus income tax for state purposes. This $10,000 limitation rule doesn't apply if you are dealing with business or an activity that's for the production of income and you incur taxes in that process. There are non-deductible taxes, and many people are shocked to know that the federal withholding on your paycheck, you are paying tax on that. So they are taxing you on the tax money that you never even see. Similarly, the Social Security that's withheld from your paycheck, also taxed. So you get no deduction. The federal government doesn't give you any deduction for the money which you are also paying it. So here's some other examples. I won't jump into those because I've hit the highlights for what's relevant to most folks. So I said a minute ago that I would revisit this state and local tax versus sales tax issue. And yes, while you are still limited to the $10,000 cap, you have to choose. So you cannot add up all your sales tax that you paid and add that to your state income tax and try and get that up to the $10,000. You have to choose. So you can either deduct sales tax or you can either deduct income tax, or if you're in New Hampshire, you don't care because you don't pay either one. But again, either income or sales tax up to the $10,000, and again, property taxes also calculates into that $10,000 limit, but just be aware that when it comes to state and local income versus state and local sales tax, you must choose which of those you're going to do. If you pay state sales tax state income tax in a year and it was for a prior year, you filed your taxes and then you realized, oh gosh, we didn't withhold enough from our paychecks, we now owe some state income tax. And that happened to a lot of people when recent tax laws went into effect and the state of Vermont anyway, didn't adjust the tax tables, the withholding tables correctly so that the state withholding was accurate. So there were a lot of people with tax bills to the state. You can deduct the money that you paid in the year you actually paid it, not the year that the tax would have been for. So if you say in 2020 you had a tax bill for 2019 and you paid the taxes owed in 2020, you can include the amount you paid in 2020 along with the amount that was withheld that you owed in 2020 on the 2020 return that you would file in 2021. Okay. And we have an example here which will illustrate all of this. We've got Colleen who amends her 2017 return in 2019, and she owes $843. Of that $843 she owes, 93 of it is penalties and interest. Now, Colleen had during 2019 $660 withheld from her wages. She also made some estimated tax payments, and don't get tripped up with this because here's where they may get you. Estimated tax payments are due quarterly beginning on April 15th. So April 15th, June 15th, August 15th, and then the following year, the fourth payment is January 15th. But remember, she's now, this January 15th is in a different tax year for deductibility purposes. So what we need to pay attention to is the fourth quarter payment from the prior tax year that she made on January 15th to calculate how much tax she actually paid in 2019 to be able to deduct on the 2019 return. So what can Colleen deduct? Well, so she can deduct the $750 in taxes that were owed from the amendment of the 2017 return. She cannot take the $93 for penalties and interest. She can take the $660 in withholding from her state tax withholding, I should say. The first three of the estimated tax payments she made for the current tax year, plus the fourth estimated tax payment she made for the prior year, which was made in January of 2019. That gets her to $2,165, which is below the $10,000 threshold, so we don't have to worry about that. And so that is Colleen. Oftentimes, you will encounter taxpayers who are homeowners and who will have property taxes on their house. They can deduct property taxes on the residence as long as it is not for things like garbage, sewer, homeowners, things like that. Those are often taxed by, or those could be taxed by the town, not the homeowners. And what cannot be taxed on the individuals is the extent to which homeowners insurance is basically being assessed to also cover the property tax that the association pays on the common area. So the taxpayer can't go in and ask for a breakdown of what's my share of the common area tax that's being paid as part of my association dues. I want to deduct that, can't do it. So all they can deduct is the tax that is taxed against the value of their property, based on the value of their property. And I should say, if there's a sale during the year, then there's an adjustment that gets made for a proration between buyer and seller. Personal property taxes, also deductible. Some jurisdictions, they charge personal property taxes based on the value of the vehicle, and those are deductible. However, if it's based on vehicle weight, you cannot deduct it. So we're going to hit a comprehensive example here and then move off of deductibility of taxes. So we've got Selma, who has an adjusted gross income of $31,300 in 2019, and she itemizes. Why does Selma itemize? Well, Selma should only be itemizing unless there is unless there is a specific limitation. Selma should only be itemizing if the sum total of all of her itemized deductions, taxes included, exceeds her standard deduction. If that's not the case, unless Selma meets some very specific criteria, Selma should be sticking with her standard deduction. So here we go. Selma's got federal income taxes of $2,150, state income taxes of $1,500, Social Security of $1,768, and paid property taxes of $3,300 on her house. Garbage fees of $867. She's got automobile fee of $210. $30 of that's based on weight. So what is Selma's comprehensive deduction for taxes? And remember, Selma would be subject to that $10,000 limitation, although probably even if all of these were deductible, she wouldn't hit that. So Selma, it's probably easier to look at what Selma cannot deduct rather than what she can. So she cannot deduct the federal income tax withholding. She cannot deduct the Social Security taxes. She cannot deduct the garbage and fees. And she cannot deduct the $30 of her car registration fee that is based on the vehicle's weight. The rest is deductible. So she's got $1,500 in state tax, $3,300 in property taxes on her house, and the tax on the personal property on her vehicle she may deduct. And so we will hope that the rest of Selma's itemized deductions gets her beyond the threshold for standardized deduction so that it makes all this itemizing worthwhile. We'll move on to interest. And so what is deductible in terms of interest? Now, way back when I first started working in a CPA firm, people could deduct taxes for consumer debt. So this meant that all the interest paid on credit card debt was tax deductible. And you bet that people with lots of credit card debt were able to get beyond the standard deduction and itemize because of the amount of consumer debt. You know, by the time they looked at interest on car loans and credit cards, it was less difficult to get over that standardized deduction and move into the territory of being able to itemize. No longer is that the case, and sadly that didn't seem to have an impact on whether or not people continued to run up credit card debt. They just now can't deduct the interest from it. So what kind of interest can a typical consumer deduct? And the answer is not a lot. So if you are a homeowner, you can deduct mortgage interest on that. If you paid prepayment penalties, and there are some jurisdictions where if you pay off your mortgage early, they will penalize you, that is deductible. If you have investment interest that you paid, you can deduct that. Not investment interest that you received. And then if there was passive activities. I'm going to make a few more points on deductibility of interest before moving on. Points, pun intended. Hopefully you'll get it in a second. So in order to be able to take an interest deduction, you need to be the one that was legally liable on the debt that incurred the interest expense in the first place. So even if you are living in mom's house and paying mom's mortgage, if the mortgage is only in mom's name, you cannot take that mortgage interest as a deduction on your taxes. Similarly, well, or not similarly, but if you have prepaid interest, the prepaid interest needs to be dealt with on an accrual basis, except if when you took that loan out, you paid points. That's the punchline to the joke. Anyway, points are part of a financing arrangement where you're essentially prepaying interest. You're buying down the interest rate. If you paid points when you took out your mortgage loan, you may be able to deduct that in the year that you paid those points, as opposed to having to capitalize them. So what can you take for mortgage interest deduction, assuming that you are in fact liable on that mortgage? Well, this has been a bit of a moving target as far as Congress goes, and right now you are allowed to take a deduction for the interest that you paid on a loan acquired for the construction, improvement, or modification, acquisition of the taxpayer's primary residence or a second home. Yes, you can go get a vacation home with a loan on it and deduct the mortgage interest, as long as you stay under the threshold amount, which right now is the mortgage has to be under $750,000. That changed. It may change again in 2025, but we'll see. Now, if the mortgage was incurred prior to December 15th of 2017, the prior $1 million limitation applies. So what happens now if you've got a taxpayer and they got their mortgage after December 15th of 2017 and it is over $750,000, they can only take the mortgage interest deduction that's paid on the $750,000. Now, what happens to the taxpayer that takes out a home equity loan, which is also a mortgage? Sometimes people don't recognize that that's what they're doing when they take out a home equity loan or a home equity line of credit. But they take this home equity loan or line of credit and they use it to pay off their credit cards or pay off their car loan or pay their children's college tuition, something other than for the improvement or construction or acquisition of their primary or a second home. That is not any mortgage interest they pay on that loan, not deductible. It was deductible, but Tax Cuts and Jobs, or it was deductible at least up to $100,000 of loan amount. That has been suspended. It may come back in 2025. We'll wait and see what happens. Now, this does not apply if the home equity loan or line of credit was used to improve the home. So if you take out the line of credit, you build a garage, that's all good. You can deduct that just as you would have if it was part of the regular mortgage. Educational loan interest is something that doesn't so much fit in what we're talking about, what we've been talking about in this video, which are below the line deductions. And why is that? It is because it is an above the line deduction. It really belonged in the earlier discussion, but because it's interest, your book authors in their infinite wisdom decided that it belongs here. Educational loan interest, student loans. The interest that you are or will be paying at some point on any student loans that you took out will be deductible as long as your adjusted gross income is below the threshold, which is on your slide here. You are limited to deducting $2,500 of your student loan interest above the line. So prior to making that determination of what is considered adjusted gross income, your student loan interest up to $2,500 comes out of that. That does not happen though if you are a taxpayer, either married or single, and you exceed these thresholds. So for example, a doctor that might have $200,000 in student loan debt is not going to probably be able to deduct any of that because they quite likely will exceed the AGI threshold on that. Lastly, on this video, I promise we're going to hit investment interest really quickly, and then I'll move on to the next video for the rest of the chapter. The key takeaway from this is if you borrowed money and turned around and invested that money, the interest that you're paying on the borrowed money is considered investment interest. And so in order to calculate your net investment income, you look at your investment income and you can subtract the investment interest from that. And so Form 4952 is where investment interest would be reported. I'm going to stop here and go on to the next video for charitable contributions.